I'm buying Nike stock and I'm really excited about it. In fact, I already own some shares. And guys, the stock is down big. It's at $74 per share when it's all-time high. Not very long ago, November 5th, 2021 was $180 per share. It is down over 60%. And for those of you who are true investors, this should excite you. So guys, back in January, I did a video of the 5 stocks I wanted to buy this year when it hit the right value. I don't care. I mean, Nike, even if they don't grow, and they said, I'm still willing to pay 17, 18 times earnings for that. Yep. Desired return, I'm doing 9, 10.5, and 12. Boom. Low price, basically 60. High price, on one of the assumptions is there, 115 and 125. Middle price, 80, 90. I'm going to add it to my watch list at $90 a share.
Okay.
As a place to start selling puts on it.
Yeah, it's on my watch list at 100.
Now, year to date, the stock is down 30%. Back then, I don't think it made much sense to me. But now the price is becoming a lot more attractive. And I want you to become the kind of investor who gets excited when a great company's stock price falls. So why has it been falling? Well, one thing is earnings just came out recently. They missed on revenue. They crushed on earnings per share. But footwear revenue also missed and apparel revenue did beat. So they missed on 2 things. They beat on 2. Now, it's interesting. I always say that news follows the stock price. And what I'm seeing now is all these other companies who've beaten Nike to the running game. There's not much mention of Jordan Brand. There's not much mention of LeBron and his shoes and how they're all crushing it. There's not much mention of apparel and how they're still crushing it. This is where news follows the stock price because the stock is down 60% from its high of nearly 180. So what are the fundamentals on Nike? So first off, guys, you have a $113 billion market cap. Okay. This is a company that did $6.2 billion in free cash flow last year. And look at this enterprise value of 126. This difference of 13 billion is essentially their debt. They can pay off their debt in full with 2 years of their last year's free cash flow. That's a great balance sheet. Forget about Nike being an amazing company and an amazing brand. The fact that the balance sheet's so good really speaks volumes about it. Now, dividend yield, 1.88%, which was a lot lower when the stock was much higher. It eats up $2 billion of their free cash flow. Guys, you'll hear me say it time and time again. I know we love dividends. I like getting dividends, but dividends are the last thing that a company should do with their cash. If this stock was fortunate enough to go from 74 today down to 40, I would hope, and this will not happen, but I would hope that Nike would stop this dividend and start buying back its shares. Because at that point, the market cap would be what, 60 billion or so? They could buy back 3% of their shares every single year with that dividend payment. That's going to be much better for investors than anything they're going to do with that dividend. I know dividends are awesome. It's a nice check to receive, but it's tax inefficient. And when you're buying back shares, if done at the right price and the right valuation, adds way more value to investors. Now, guys, look at this return on invested capital. This is a sign of a good moat. This is a sign of a strong company that has pricing power. This is what we want to see. Companies with higher ROICs tend to last longer, tend to be able to build on their profit at a much better rate than everybody else. Now, let's go check out our important 8 pillars. Now, remember, the 8 pillars tell a story. They're not telling you to buy or sell. They're telling you a story. And right now, we have 2 X's. Now, you might be sitting there saying, wait a second, Paul. 23 times 5-year PE, 25 times free cash flow, and this is something you're buying? Remember, guys, you need to pay a premium for moat businesses. Businesses that are great brands deserve a premium. What is the right premium? Everything else is a check. Revenue growth, $10.3 billion in the last 5 years. That led to only $900 million in net income growth, but led to $2.8 billion in free cash flow growth. Debt low, shares outstanding, buying back a few shares, but again, I don't want them buying back expensive shares. So this story is telling me, okay, maybe it's a pricing thing, but what premium you willing to pay? Because remember, look at this. Look at their free cash flow now. The 1-year free cash flow multiple is only 18 because their 5-year average was $4.5 billion versus their 1 year of 6.2. So their free cash flow has really increased a lot in the last year. Is that stable? Are they going to grow from there? That is the question that really matters when valuing companies here. Because obviously the more growth you have, the worse this ratio is going to look. Now, a lot of people have been talking about how Nike is losing the shoe game. I don't understand how, but look at this. Nike plans $100 and less shoe after sales plummet following a sales slump. Now, some people might sit there and say this is great. They're sitting there saying we need to refocus. Now, one thing I love that the CEO said, which was very revealing to me, he blamed the lack of product innovation to allowing other competitors to come in and steal some market share from Nike. I love that admission. To me, that's not a CEO just telling me what I want to hear. The stock is down and he made a negative assessment on his company. And to me, it also said to others in the company, guys, let's innovate better. Let's be a better company. Yes, it's wonderful to have a $250 shoe, but you're Nike. If you want to grow your revenue and profit to much bigger levels, you're going to have to be able to expand the people you sell to. Guys, this is the Q4 fiscal year 2024, the breakdown. $8.2 billion in footwear, down 4%. $3.3 billion in apparel, up 3%. $0.6 billion in equipment, up 34%. So there's a lot of growth potential here. And finally, Converse, $500 million, down 18% year over year. So guys, 2 growth categories, 2 declining. They got to turn this thing around. But if they're able to turn that around, they're going to be able to really grow the profit and free cash flow of this company. Now, here's another cool thing. China, 3% year over year growth. Rest of the world, decline of 2%. But China's a growing market. You've got the largest middle class, 1.6 billion people. Yes, they've had a decline in population last year, but a lot of people making more and more money. Do you think that's going to help Nike sales or not? Yes, there's a lot of Chinese footwear companies out there. I do not disagree with that. They've gotten some US athletes to sign on, which is great. But Nike is still Nike. And of course, Jordan brand. What a big brand. Look at these Jordan sales as a percentage of Nike sales. It is growing. Started at 7% in 2014, had a little decline in 18 and 19, now 13% of all of Nike sales. Guys, I think Jordan gets them like 5%. I don't know if the movie was accurate, but he gets checks of $200, $300 million a year for his share of the Nike revenue, which is absolutely incredible. Now, here's Nike's revenue every quarter over the last 5 years. Well, it's been pretty stagnant, actually, guys, since Q4 2021. Pretty stagnant levels. So they're going to be invigorated here. They got to get back to growth mode. This is something important for Nike and for the investors to find appealing. Of course, selfishly, I want them to stagnate for a while. That way people continue to sell the stock and it goes lower and lower and lower so I can dollar cost average at much lower prices. If I'm able to do that, then Nike, as long as it sticks around and grows like the company I think it is over the next 10 or 20 years, I will make a great return on the money invested into that company from my pocket. Now, guys, this is Nike's North American revenue from 2009 to 2023 by segment. Okay, the biggest one, growth right here, 344 to 764 million in equipment. And we still see growth in every category. Actually, this is the biggest one. Sorry, apparel, 1.74 billion to almost $6 billion. That is big time growth. In fact, equipment, I was wrong, is actually the smallest one. But look at this revenue overall, 6.8 billion to 21.6. Guys, remember, there's always going to be a lot of negative news following any stock that declines. The question is, how do you take away the news that really matters versus the news just following the stock price? Now, let's go see what analysts are saying about Nike. Now, remember, these are just analysts. They have probably more bias than you and I do because they have career risk. If they're wrong, they need to be around the curve. So, EPS growth from 378 this year to 636. This is double-digit growth almost every single year. Okay, so not bad. A lot of growth still there for Nike. Revenue growth, boy. I literally am reading articles about Nike losing its position, and this is examples of news following the stock price. Guys, if you've watched our videos before, these are the 3 questions I ask when I look for a company I want to buy. 1, do I think this company will be around for the foreseeable future? Will Nike be around for 10, 20, 30 plus years? What does our world look like if 30 years from now there's no Nike? Okay. 2, do I think they're going to have more revenue and profit in this future than they have today? Again, do you think Nike has staying power? Forget about where the stock price has gone. Look at the fundamentals of the business. And number 3, if the answers to 1 and 2 are correct, are yes, can I pay a price today that factors in this future growth and gives me a good return on the money that I'm investing? That is the ultimate question. If you're able to answer all three of those as a yes today, then it's probably something you want to look at. And I think Nike fits that criteria. But what is the right price for Nike? Now, guys, you've probably noticed that we have limited daily spots for our Everything Money community and our software. And the reason for that is because the software as it exists today includes everything we have to offer for stocks, retirement, and real estate in all of these tools above. Okay, now we are going to be making some changes behind the scenes. So in the near future, the current offer that's on the site today is going away. As we've been getting feedback from our community members, people have said they want us to focus on particular aspects of our Everything Money tools and don't want too many options when they're using the software. We don't want to be the cheesecake factory of software. Now remember, if you remember this channel from years ago, I built the software selfishly for myself and my team so that we can use it to constantly help make the right decisions for stocks, real estate, and retirement. But as the channel's grown and our community's grown, it's becoming less about me and more about how I can better serve you. But the good news is we have not made those changes yet. So if you join the software today, you'll be grandfathered in for life with all of the tools. And this is going to be the best deal we're ever going to offer. And I'm telling you this now because obviously there still is time for you to sign up as long as you join the EM community today before we make the changes. You'll be able to keep all of the tools. So click the link in the description below to get access to Everything Money and everything we have to offer, and it'll be the best decision you've made all year. So one of those decisions is, what's the right price to pay for Nike? So this is our stock analyzer tool. I'm doing a 10-year analysis. Remember, guys, this does not factor in any of the balance sheet, okay? So revenue growth. First, I did 3, 5, and 7% for my low, middle, and high, all right? Profit margin, I did 10, 11, and 12, and same with free cash flow. A little bit higher than history because I figured that with their more direct-to-consumer selling, there'll be a higher margin for them, so they should be able to bump up those cash flow and earnings margins. Now, what's the PE at the end of 10 years that you would assign to Nike? It's a premium company, guys. The market average is 15, but you got to pay a premium for great companies. I put 20, 23, and 26. Now, if you said 30 to me, I'd say, yeah, I could see the argument for that. If you said 15, I'd be like, that's kind of low for Nike. It's somewhere in between. I don't know the exact number. That's what makes this software so great for you. You can pick based on your perception and understanding of Nike. I feel like 20, 23, and 26 is a great PE and price to free cash flow for Nike. And finally, I put in a 9% return. Why? Because the market's going to do 9 or 10%. So this is the market return. This has no margin of safety. You need your margin of safety because you're buying an individual company. If you just want to match the market, buy a low-cost ETF. We're humans. We make mistakes, and the future's unknown. So you need a higher return for that margin of safety. But based on the market return, hit the Analyze button. I have a low price of 61, high price of 120, middle price of 86, and this includes the dividend. So for me, I feel like I'm adequately buying at prices that goes lower. Remember, focus on the fact that you want the stock price to go lower, and don't forget to click in the description below to sign up for our software today. Thank you for your time.